In the winter of 1955, a rural onion farmer executed a market-devastating manipulation to the American economy that the United States government had to pass a federal law to ensure it could never, ever happen again. This is the story of Vincent Kosuga, the Onion King. To understand the genius of Kosuga, you have to understand the fundamental difference between owning a physical asset and trading a paper derivative. This is the ultimate lesson in the economics of owning. In the 1950s, the Chicago Mercantile Exchange was the center of the commodities world. If you were a farmer growing onions, your livelihood was at the mercy of the weather. Onions spoil quickly, and if the harvest was too good and everyone's crop came in at once in good condition, the market will become flooded and prices will collapse overnight. To protect themselves, farmers used futures contracts. A futures contract is simply an agreement to buy or sell a specific amount of an asset at a set price on a set future date. It allowed a farmer to lock in a price months before harvest, ensuring they didn't go bankrupt when supply exceeded demand. Vincent Kosuga was a farmer from New York, but he had the mind of a predatory hedge fund manager. Alongside his trading partner Sam Siegel, Kosuga identified a fatal structural flaw in the Chicago onion market. Because onions spoiled so fast, they couldn't be stored long-term like wheat or gold. The market was small, localized, and dangerously sensitive to supply shocks. Kosuga didn't want to predict the market, he wanted to own it. From late 1955 into 1956, Kosuga and Siegel began quietly buying up physical onions by the trainload. They rented out massive warehouses across Chicago. The two men controlled an estimated 30 million pounds of onions, a 90% share of nearly the entire available onion supply in Chicago. Because they controlled the physical supply, they drove the price of onions up through artificial scarcity. The price of a 50-pound bag climbed to $2.7, a premium price at the time. Kosuga and Siegel approached the commodities traders on the floor of the exchange with a straightforward offer. Buy our physical onions at this high price, or we flood the market and destroy the value of your entire portfolio. Faced with the reality of that stockpile, the traders agreed. They bought millions of pounds of physical onions from Kosuga just to keep him from dumping them into the market and crashing the price of onions. But unknown to the traders, he and Siegel opened massive short positions on onion futures worth millions of dollars. They were betting on the price of onions to collapse. The traders thought they had bought him off. They thought the market was safe. But Kosuga wasn't entirely truthful. He still held warehouses full of onions, and when he was ready, he pulled the trigger. He dumped his remaining physical inventory onto the market all at once. The supply shock was catastrophic. In a matter of weeks, the price of a 50-pound bag of onions plummeted from $2.75 down to just 10 cents. The cash was disastrous because the burlap sack used to hold the onions cost 20 cents to manufacture. Kosuga had crashed the market so completely that the bag itself was worth twice the 50 pounds of food inside it. Farmers across the United States were instantly bankrupted. Millions of pounds of rotting onions were dumped into the Chicago River because it was cheaper than transporting them to a landfill. Generations of farming wealth were wiped out in a matter of days. But Vincent Kosuga made a fortune. His short positions in the futures market printed money as the physical price collapsed to near zero. He had engineered his own market crash and placed his bets on the way down before anyone saw it coming. The fallout reached Washington, D.C. Gerald Ford, then a congressman from Michigan, years before he became the 38th president of the United States, was among the legislators who pushed hardest for a legislative response. The government's conclusion was stark. The paper derivatives market had completely detached from the reality of the physical asset. The futures contracts weren't protecting farmers anymore. They were being weaponized against them. In 1958, President Dwight D. Eisenhower signed the Onion Futures Act into law. It was a targeted, unprecedented piece of legislation to ban the trading of futures contracts on onions. Not corn, not wheat, not soybeans. Just onions. Over 65 years later, that law is still on the books. You can trade futures on crude oil, gold, natural gas, and the S&P 500. But if you attempt to trade a futures contract on an onion in the United States, you are committing a federal crime. Before we get back to the video, we would like to mention that we share live trades on our Telegram channel. You don't need to manipulate the market like Vincent Kosuga. Our trades are publicly shared so you can profit from the market. The link to join is in the bio. Now, back to the video. Onion futures contracts might have gone extinct, but the mechanics of manipulation and the ruthless exploitation of supply, demand, and human panic have not changed at all. Now we have leaders of the world openly participating in this exploitation. Does the government need to step in and regulate certain financial derivatives today? Or was the Onion Futures Act an overreach that punished an entire market for one man's genius? Let me know what you think in the comments. Please like and subscribe for more videos like this.